For as long as most of us can remember, there's been this one single three-digit number that holds all the power when it comes to buying a home. Yep, the credit score. It's kind of been the ultimate gatekeeper, deciding who gets the keys and who's left standing outside. But what happens when that gatekeeper all of a sudden changes the locks? Well, that's exactly what we're going to dig into right now.
I mean, have you ever felt that way? Like your entire financial life is just boiled down to one number. A score that has no idea you've paid your run on time for years, or that you're super responsible with your money. For a lot of people, this system worked. It opened doors. But for so many others, it just slammed them shut.
And that is exactly why this is such a huge deal. Because right now, the rules are changing. Fannie Mae, we're talking one of the absolute giants in the mortgage world, is basically redrawing the entire map for homeownership.
All right, so here's how we're going to break this all down. First up, we'll look at this crack in the code. Then we'll dive into the new homebuyer playbook. After that, the really important part, what it means for you. Then we'll zoom out for the market's big shift. And finally, we'll try to peek into the future of the loan.
Okay, let's jump right in. Section 1, a crack in the code. For years, years, the whole foundation of mortgage lending was built on this super rigid black and white principle. And, well, that foundation just got a massive crack in it.
So here it is, the big news. Fannie Mae has dropped its minimum FICO requirement. Just gone. That hard line in the sand, that 620 score that was like a firewall for so many people, it's been erased for a lot of these loans. And believe me, in the mortgage world, this is nothing short of an earthquake.
And just so we're all on the same page, a FICO score is just that quick three-digit snapshot that lenders use to basically size you up. For decades, it's been the very first hurdle you have to clear. And a lot of the time, it was the only hurdle that mattered. Well, until now.
Which brings us right to Section 2, the new homebuyer playbook. Because what's happening here is way more than just a rule change. It's a total shift in philosophy, moving away from just a number and toward understanding someone's entire financial story.
And this really shows you the before and after. On the left, you've got the old way. It was basically a hard stop. If your score was, say, 619, you were just out. Game over. Simple as that. But now, look at the right. The new way is more like a magnifying glass. It's called a holistic review, where lenders are supposed to look at your entire financial picture.
So what in the world is a holistic review? Well, it just means that the people approving the loans, the underwriters, are now digging way deeper than just that one score. They're looking at things like how stable your income is, how much cash you have saved up, and this is the really big one, they're looking at alternative credit data. Things like a solid history of paying your rent or your utility bills on time.
Okay, so that brings us to Section 3, and this is probably what you've been waiting for. What does all this actually mean for you? Because this isn't some abstract policy change happening in a boardroom somewhere. This could have real, direct consequences for anyone dreaming of owning a home.
So let's get right to it. How does this impact you? Well, it's kind of a mixed bag, a real balancing act. The good news? The door to homeownership could swing open for a lot more people, especially if you're responsible with money but just don't have a long credit history. But there's a catch. That access might come with higher interest rates or fees. You'll probably have to provide a lot more paperwork, and the whole process might take longer. And a really important point, this isn't a free pass. Individual lenders can absolutely still set their own minimum scores.
So the whole application journey is going to look a little different. Step 1, submitting the application, that's pretty much the same. But Step 2 is new. That's where you'll provide all that alternative data we talked about. Proof of on-time rent, utility payments. And then Step 3, a human underwriter, not just a computer program, is going to do that holistic review of your entire financial story. It's definitely getting more detailed, and you could say a lot more human.
All right, let's pull back from the individual homebuyer for a second and look at the bigger picture. Because a change this big doesn't just affect you. It sends ripples across the entire financial system. That's what we're covering in Section 4, the market's big shift, and how lenders and investors are scrambling to adapt.
For the lending industry, the biggest takeaway is this. Underwriting is becoming way more subjective. Think about it. That simple, automated assembly line yes or no is being replaced by actual human judgment. And that puts a whole lot more responsibility on the underwriters. And of course, more subjectivity usually means more risk, or at least the perception of more risk.
So, what are the people who actually fund these loans? The lenders and the big investors? What are they going to be watching for now? Well, it really all boils down to managing that risk. Lenders are going to be relying more heavily on their own internal models. They're also going to have to keep super clear documents explaining exactly why they approved a loan. At the same time, investors are probably going to ask for way more detailed reports, and you can bet they'll be monitoring how these loans perform, watching for any signs of default like a hawk.
And all of this leads us to our final section, the future of the loan. Because let's be real, this isn't just some minor tweak to the rules. This is a fundamental rethinking of who gets a shot at the American dream.
There's a great quote that really sums up this whole shift. It says, "We're entering a new chapter in mainstream mortgage underwriting, one where traditional score thresholds give way to more nuanced credit evaluation." I mean, that's it in a nutshell, right? We're moving from a simple number to a much more complex and hopefully a much more fair financial story.
And that leaves us with the one big unanswered question. Will this create a whole new generation of homeowners, or will it open the door to a new wave of risk? This has the potential to open up homeownership for so many people. But let's be honest, with any huge shift like this, there are always risks. So everyone is watching. The industry, the economy, and of course, people just hoping to buy a home. Is this the start of a stronger, more inclusive housing market? Or are we introducing a new kind of risk that we're just not ready for? I guess only time will tell.